everybody. Welcome to the Intelligent Property Investor Weekly Masterclass. We've had a big week. There's lots been going on economically and how it affects the property market. And that's why I do the weekly updates for you, because I want you to make better decisions, because better decisions make more money. And when you understand what's actually going on, you're able to then formulate your decisions on some real data as opposed to just persuasion or fear, which is actually what most people act out of. And it doesn't get them very far, which is why everybody is not exceedingly wealthy right now. So, look, if you're listening to me on any of the podcast platforms like Spotify or on iTunes, I really want you to go across to my website, iloverealestate.tv, and have a look at all of my slides, because I've got a lot of charts to show you, particularly this week, about what's going on and how it affects the property market. And there's a whole lot of other free stuff there for you as well. So jump across to my website, subscribe, particularly if you're on YouTube or any of the other channels like that, because then you'll get these coming to you weekly and it keeps you updated. And the more you immerse in the kind of information that we go through, which is the real data, the more confidence you'll have, the more clarity you'll have around your decisions. So let's get into it. All right. Why are we in this super cycle in housing demand? That's really a big topic for now, and it's really the good reason as to why the prices are where they are and where they're likely to go. Why markets are jittery and businesses are worried, but businesses are still flush with a lot of cash. So I don't know why they should be worried when there's so much strength in their balance sheets. Why unemployment has fallen to the lowest level. Why there's no pink recession. Have you heard that terminology before? Pink recession. We'll get into that during the talk as well. And why land prices are booming, but lot sizes are shrinking. And even though it's 9 months since the home builder ended, all of those boosts that we put out for new construction, they've all gone 9 months ago, 10 months ago. So, why is it still booming right now? So let's get into it. Look, I don't normally, like to talk about COVID and Omicron and Delta and all the rest of it. I think we're all absolutely sick of it. Personally, I am. I don't know about you. But I do need to talk to how Omicron is affecting the housing market. And is it actually a sign of a market downturn? Well, let's have a look at that. And they're mainly talking about the share market. And I think a lot of people get really confused about whether we're talking about the share market or whether we're talking about the property market a lot of the time. And, I think the fear that is put into people through the mass media, all of those other things, it puts people into stall. And when someone's in stall mode, they simply don't act. And now is not the time to be in an inaction process. Now, during the week, we had some survey figures come out by NAB, the NAB economists. So let's have a look at what they're saying, because they do a deep dive into businesses particularly. So this is the business confidence. Now, you can see there it's taken a downturn. And this is really with the opening up with Omicron. We had the big case numbers and all of that kind of stuff. So it did for big business, and particularly for the investors in big business, meaning the share market. And a lot of that was due to people off on isolation, and you're a close contact, so you're in isolation even though you've got no symptoms and all these kind of things. So it affects the labour force dramatically. And that's really playing out a lot in a lot of the figures right now. It's the supply chain, and that includes labour right across the board. Now, labour costs are actually up. If you look at the end of the calendar year 2021, labour costs were up, but they need to be, because we haven't had wage increase for a long time, something like 8 years, I think it's been. So the labour costs are up because there is such short demand of short supply of labour. Consequently, demand is very high, particularly in the construction industry, and that's pushing up pricing. But it's not long-term pricing. It's not salaries. It's not a lot of the longer-term awards and the unions and all of that kind of activity. A lot of it is in the contractor market, particularly in the construction industry, because you can't get a tradie for love nor money at the moment. Now, that's pushing up material costs. So material costs are up, and a lot of the international tensions and political tensions that are happening around the world are actually adding to this pressure on supply chains and ultimately to confidence. So, you've got the Middle East going on over there, you've got China and Taiwan, you've got, Russia and Ukraine, you've got fuel shortages in Europe, you've got all of these factors which are adding tension across the globe. Now, it's not internal, it's not domestic. It's absolutely international, but it is having a little bit of a flow-on effect, and I think that's what's affecting a lot of these figures. So that higher labour costs, the higher material costs, is actually pushing up the end sale price of goods. But I think I want you to really look at here. You see, the margins are still good. So what the sellers have been able to do is to keep their margins secure by just increasing pricing. And that is obviously having an inflationary effect, which I'll talk about a little bit later. When you look at the forward orders, we're still pretty good, even though that does show a little bit of a downturn on a seasonally adjusted trend. It's above where we've been in previous years. So, that's still pretty good. When you have a look and you go back to 2018, 2019, you'll see there before obviously COVID happened, you'll see there that they were tracking along that zero line. Well, we're well and truly above that, up, even though the trend is down, we are still substantially higher than a lot of the years that we would have considered to be normal years. Capital expenditure has taken a bit of a flat line, it's levelling out, and that's to be expected. There's a lot of capital expenditure going out with new new machinery and upgrades, and a lot of cars and trucks and all of this kind of thing. Went through a big upgrade when we had a few incentives through 2020 and 2021. That's starting to level out, and that's to be expected. I mean, you just can't keep spending money on capital expenditure all the time. I think a lot of the money in for that upgrade has actually already been spent. But cash flow is good. If you look at this chart, you can see here cash flow is higher than it's been for a number of years, 4 or 5 years. The cash in the balance sheets across the businesses is very good. And, businesses are also running at full capacity. So all of that means it's really, really healthy for Australia and for the businesses as a whole. So even though we see a lot of the jitteriness happening, a lot of it is due to, and I'll talk about this perhaps in another podcast, what we call the story stocks, which are the stocks that are really on fluff and bubble. A lot of the stocks that really don't do a whole lot. They don't necessarily make a lot of money. They just, have a whole lot of potential in there. And a lot of that type of thing is really correcting, which I think is a good thing, because they are fluff and bubble. They are not the kind of long-term businesses that actually produce something and sell something and make that are going to have longevity. These other ones, I mean, it's a bit like it's a currency. That was it, for the crypto particularly, and it's just supply and demand on fluff and bubble, really. So let's have a look from an economic summary perspective. What does all that mean for property? So even though the future is a little bit uncertain with Omicron and the borders opening up, and Omicron being highly contagious, but not that bad really, fundamentals are still really strong. So the underlying economy is super strong, and that's the base from which we have to build. It's likely to get even stronger when we have tourists coming in. We've got, travel opening up very soon. We've got all of these other things happening. So it's going to get stronger, not weaker. And then, when we open the borders for immigration, wow, over yourself, because now is not the time to be scared. In fact, get educated. That's what you have to do. Get educated, get smart, start investing smart rather than trying to invest hard. And there's a lot of rubbish in the market. I got to tell you, there's a lot of rubbish in the housing market, and there's more and more pouring out all the time. So I want you to make sure that you get yourself educated before you take the plunge, but there's lots of stuff to be out there to be had, which will really benefit you. Now, the second thing I want to talk about here is unemployment and how it's fallen to the lowest rate in 13 years. So we've got this booming economy. The economy is growing. It's doing really well. And then we've got the unemployment rate coming down. Now, at the moment, we're sitting at in the fours, the low fours. The likelihood is that that's expected to go even lower into the threes. So we could even have a 3 in front of the labour market. And a lot of that is also due to our borders being closed because, there's more jobs around now than there has been in 13 years. So there's more people employed now than there has been in 13 years. So that's a pretty good milestone to have. So this chart really shows the unemployment statistics. The likelihood is that we will see a 3 in front of unemployment. Now, as an economist, I don't think I can remember a time when we had a 3 in front of unemployment. I mean, we got pretty low when we started to have all the boosts that came out with GFC and other things, but 3 is a pretty low number for unemployment. And when you look at the unemployment to population ratio, to population ratio, you can see here that there are more Australians employed than ever before. Now, that chart there goes back to 1999. I didn't take it back any further than that, or macro business didn't take it any further than that. But you can see there that's the highest number of Australians that have been employed since the late 90s. So that's absolutely incredible. And that indicates a strong economy, which indicates a strong housing market, which is what we've got to start looking at. When we look at payroll per sex, now this is interesting because when COVID started and we all got scared and all the rest of it, the commentators all said that the likelihood was that women were going to be the most affected and they would lose their jobs first because they were mainly the ones in casual positions and hospitality and a few of those other things. But what we're actually seeing here is that the males are back to pre-COVID levels, but the women are actually at higher levels. The women are more employed now than we were pre-COVID. So that is really cool. That is something that was not expected as an outcome from this. And you can see there where we've had dips along the way and other things, and that's mainly the hospitality industry. But some of the big industries that do employ a lot of women are aged care, and there's a lot more to be needed there. Healthcare, the dip that we might have seen in some of the hospitality industries. This has been put out by ANZ. This is the ANZ Job Advertisements Index. And you can see there we're very high, but there's still some upside because if you go back to GFC or the end of GFC and what happened thereafter, you can see there that we haven't reached the peak that we reached for job ads that we did when we came out of GFC. So there's still some upside to be had perhaps, which is why, again, we could get down to a 3 in front of us for unemployment, which is, as I say, that is incredible and something that I can't remember seeing. I mean, maybe I've had a glitch in memory. I'm getting a little bit older, but employment versus vacancies, and you can see there that the unemployment rate there is in the red, but the vacancies are even further. So again, what this chart tells us is that the likelihood is that unemployment is going to go down, employment is going to go up. So because there's more job ads than there are for people that are unemployed at the moment, which is a crazy position to be in. I mean, imagine having 100% employment. That's unheard of it's heard of in a technical economy, but certainly not in real life. But that's where we're heading. Look, that's crazy stuff. Particularly when the job ads are indicating something closer to 2% unemployment, not up in the 4s where we are right now. So crazy, crazy stuff, but really good stuff. And that all augurs very, very well for the housing market. A lot of people, particularly last year and the year before, were saying things like, there's going to be a recession and we're going to have housing prices drop because everyone's going to lose their job. Well, that's not happening. In fact, we can't get enough labour. That's really where we're at. So the new housing is facing this super cycle in demand. And there are 5 segments that perform particularly well. So let's have a look at a normal market cycle. Now, in this market cycle, you can see there we'll start with phase 1 is the recovery. So this is just a normal market. It's not the one we're in now, but it's the normal market. We're in a recovery phase. Things are improving. We've come off a low. We've got declining vacancies. We've got no new construction. So we're really kind of just in that recovery mode. Then we get into phase 2, which is expansion. So we've still got vacancies coming down, but we've got a lot more new construction happening. Then we go to phase 3, for supply. So we increase vacancies, so we're going a little bit into oversupply now. We're still constructing, so we're exacerbating the situation, which is why the market's in a downturn. And then we have increased vacancies and more completions. Is when all of those supply chain. So that's typically what happens in a housing cycle market. This is the real estate market. You can see there it's the same. It's the same in the recession, but where are we right now? We are just really at the start of that expansion phase. That's vacancies are nowhere near increasing. We're still in a decreasing vacancies. Construction is still moderate to moderately high. Rental rates are still growing. They're not going down, they're going up. And the absorption rate means that we are still in massive undersupply and over demand. So that's something that, I really want you to take on board and to, have confidence in as we move through these markets. This is the private new house sales, and you can see here that we've actually had increases for 5 quarters in a row. In fact, the HIA came out and they were saying that sales of new detached housing has increased by 11.3% for that's for the December quarter. Now, it's the 5th consecutive increase that we've had in new home sales in 9 months, and that's the 9 months since we had that builders boost. And this is the highest level of new housing sales since 2011, which includes the 3 largest spikes associated with the home builders. Now, the underlying demand for housing remains exceptionally strong as the pandemic continues to push households towards lower density living. The more time people down and working from home, the higher is the demand for detached housing and renovation activity. Now, these factors are driving the super cycle of housing demand in Australia. So that was put out by the HIA and their economists, and what was happening through the year there. So let me just get this camera thing happening correctly for you there. All right, this is a snapshot of the building activity pipeline, and you can see there's plenty in the pipeline, but it's not going to go anywhere towards what we need to from a demand perspective. This is lot sizes are decreasing while housing is booming, and the reason for that, of course, is affordability. A significant increase in price of land indicates that supply is not keeping pace with demand. So that's one of the other economists talking there about what's happening in the housing industry. So, all of that means we've got further growth to be had. Affordability crisis shrinks the house lots. That was put out in the Fin Review recently. So what does all that mean? What it means is we have some good times ahead. We have a lot of upside to eat up the underlying demand. We're nowhere near supply equaling demand, and it's going to be quite a long time before any of that really kind of takes place. So that means the house prices have upward pressure on them. So the sooner you get yourself educated and the sooner you get yourself into the property market, the better results you're actually going to have. My thought for the week is this one. You are what you do, not what you say you'll do. You are what you do, not what you say you will do. So what are you going to do as opposed to just talk about it? And I think if you can take that message on board and implement it into your life, your bottom line balance sheet and bank account is going to be a whole lot stronger, because so many people have missed out on the rises that we've already had. You don't want to be sitting on the fence missing out on the opportunities that are ahead of us for the next few years. So how do you do that? You take up one of my free 60-minute real estate breakthrough sessions. They're with one of my advisors. I've set a few advisors aside just to talk to you. They are free. They are 60 minutes long. And, all you got to do is click through. You go to iloverealestate.tv/questions/ or click through on the links, etc., if you're watching me on YouTube or something like that. And you'll be able to take up one of those sessions. I think it's vitally important that you come armed with where you want to go. My advisors will talk to you about what we can do to help you in that quest, and how time is really of the essence. So look, I hope you have enjoyed this week's Intelligent Property Investor Masterclass. I certainly have. And I'll be back again to talk to you next week with some more exciting news about what's happening in the property market. So I'll catch you then, guys. Bye for now.